Welcome back to Money Talks. I'm your host, Rita. It's great to have you with us again. Our last episode on equity transactions was a fantastic deep dive, and the engagement from you all was just incredible. Before we jump into today's topic, if you're finding these episodes helpful, please take a moment to comment, share, and subscribe. We're hoping this material can not only make you a more informed investor, but also help some of you pass the Canadian Securities Course, or CSC exam, and, looking ahead, the new C.I.R.O. exam called the Canadian Investment Regulatory Exam, or CIRE, starting in January 2026. Your support helps us reach more people just like you. Now let's get into it. Hey, Julia, it's great to welcome you for the first time on the Money Talk show. How's everything going?
Hi, Rita. Thanks for having me. Everything's going well, just navigating the interesting world of finance, as always. It's a pleasure to be here.
We're so glad to have you. I've been thinking a lot about corporate financial statements lately. It's a topic that can feel really intimidating for a lot of people, but it's so crucial for anyone interested in investing or even just understanding the health of a company. Can you break it down for us?
Absolutely, Rita. It's a fantastic topic, and you're right, it's not as scary as it sounds. Financial statements are a company's report card. They tell you how a company is performing and what its financial health looks like at a specific point in time.
A report card. I like that analogy. So where do we start? What are the different types of grades we're looking at?
Well, before we dive into the statements themselves, it's helpful to quickly understand the different ways a business can be structured. The most common ones in Canada are sole proprietorships, partnerships, and corporations. A sole proprietorship is a one-person show where the owner and the business are legally the same. A partnership is similar but with two or more people. For both, the owners are personally on the hook for any business debts.
So if the business goes under, their personal assets are at risk?
Exactly. That's why for larger ventures, the corporate structure is so common. A corporation is a separate legal entity from its owners, who are the shareholders. This means if the company goes bankrupt, the shareholders generally only lose the money they've invested. This is called limited liability, and it's a major advantage. Corporations can also raise money much easier by issuing shares or debt.
That makes sense. It provides a safety net for investors. Are there any downsides to being a corporation?
There are a few. They can be more inflexible due to regulations, and there's the possibility of double taxation, where the corporation pays tax on its profits and then shareholders pay tax again on the dividends they receive. But for most large businesses, the advantages far outweigh these.
Got it. So let's talk about that report card, the financial statements. What are the key ones we should know about?
There are three main statements that work together to give you a full picture. These are the Statement of Financial Position, the Statement of Comprehensive Income, and the Statement of Cash Flows. In Canada, public companies follow International Financial Reporting Standards, or IFRS, which are principles-based accounting standards used in over 100 countries. This focus on detailed disclosure makes the statements more transparent and easier to compare between companies.
Okay, let's take them one by one. What's the Statement of Financial Position?
This statement is like a snapshot of the company's financial health on a single day. It shows what the company owns, what it owes, and the owner's stake. It's based on a fundamental equation: assets equal liabilities plus equity.
Assets, liabilities, and equity. Let's break those down.
For sure, assets are everything the company owns that has value. This includes current assets like cash, inventory, and money owed to them by customers, which are called trade receivables. It also includes non-current assets, which are long-term things like property, plant, and equipment. Think of a big Canadian retailer like Canadian Tire. Their assets would include their stores, warehouses, the products on their shelves, and the cash in their registers. And what about liabilities? Is that just debt? Liabilities are what the company owes to others. This includes current liabilities like bills from suppliers, trade payables, and short-term loans that need to be paid within a year. It also includes non-current liabilities, which are long-term debts like mortgages or bonds that are due further down the road. So for our Canadian Tire example, a liability would be a loan they took out to build a new distribution center.
That leaves equity. What does that represent?
Equity, or shareholders' equity, is what's left over for the owners after you subtract the liabilities from the assets. It represents the shareholders' stake in the company. It's often called the book value of the company. This includes the money originally invested by shareholders, known as share capital, and the profits the company has kept over the years, called retained earnings.
So if a company has a lot of assets and very few liabilities, that would mean a high equity, which is a good sign for investors.
Generally, yes. It shows the company has a solid financial foundation.
Okay, so that's the snapshot. What about the story over time? Which statement tells us that?
That would be the statement of comprehensive income, sometimes called the income statement. This statement shows the company's financial performance over a period of time, like a quarter or a full year. It tells you if the company made a profit or a loss.
So it's like a video of their performance, whereas the statement of financial position is a photo.
Exactly. It starts with the revenue, which is the money the company earns from selling its products or services. Then it subtracts the cost of sales, which are the direct costs of producing those goods or services. What's left is the gross profit.
And I assume other expenses are deducted from the gross profit?
That's right. After the gross profit, you subtract other operating expenses like marketing, administrative costs, and interest on debt. After all of that, and after paying taxes, you get the final number, the profit or loss for the period. This is the famous bottom line.
It seems like a lot of information is packed into that one statement.
It is, and it's incredibly valuable. It helps you understand where the company's earnings are coming from and where the money is going.
We've covered the snapshot and the video. What's the third key statement?
The third one is the statement of cash flows. This one is crucial because it tracks the actual cash moving in and out of the company. A company can be profitable on paper, but still run into trouble if it doesn't have enough cash to pay its bills.
Why is that? How can a company be profitable but not have cash?
A good example is when a company sells a lot of products on credit. The income statement will show that revenue, but the company might not have collected the cash yet. The statement of cash flows is broken down into three main activities: operating, investing, and financing.
Can you give us a quick rundown of what each of those means?
Of course. Operating activities are the cash flows from the main business operations, like cash received from customers and cash paid to suppliers and employees. Investing activities show the cash used for investments, like buying new equipment or property or selling old ones. And financing activities show how a company raises money and pays it back. This includes issuing or buying back stock, taking out loans, and paying dividends to shareholders.
So by looking at all three statements together, you get a really comprehensive view of the company's financial situation.
You've got it. They all connect and tell a complete story. The profit from the income statement affects the retained earnings on the statement of financial position, and the cash flow statement explains how the cash balance on the statement of financial position changed from one period to the next.
This has been incredibly insightful, Julia. You've really managed to simplify some complex topics. Before we wrap up, are there any other key things investors should look for in a company's financial reports?
Definitely. Always read the notes to the financial statements. They contain a lot of important details that aren't in the main statements, like accounting policies and more information on debt and other commitments. Also, look for the auditor's report. An independent auditor reviews the financial statements and gives an opinion on whether they are presented fairly. This provides an extra layer of assurance for investors.
That's great advice. And for public companies in Canada, there are strict rules about disclosing this information, right?
Absolutely. Public companies, or reporting issuers, have to provide regular updates, including annual and quarterly financial statements. They also have to immediately report any material changes that could affect their stock price. There are also regulations around takeover bids and insider trading to protect all investors.
It's clear that understanding these financial statements is a powerful tool for any investor. It allows you to look past the hype and really see what's going on inside a company.
That's the goal. It empowers you to make informed decisions and ask the right questions about where you're putting your money.
Julia, thank you so much for sharing your expertise with us today. You've given our listeners a fantastic foundation for understanding corporate financial statements.
It was my pleasure, Rita. I'm happy to help demystify the world of finance.
And a big thank you to our listeners for tuning into Money Talks. We hope you enjoyed this breakdown of corporate statements. Don't forget to hit that subscribe button, leave a comment with your thoughts, and share this episode with anyone who might find it useful. Your engagement means the world to us. Stay tuned for our next episode where we'll be talking about financing and listing securities. You won't want to miss it.